Ladies and gentlemen, welcome. I'm Paul Kaufman, Dean of the Faculty of Business and Economics, and it gives me great pleasure to welcome you to the 2018 Finch Lecture. I would like to begin in the customary way by acknowledging the Wurundjeri people of the Kulin Nations, the traditional owners of the land on which tonight's event takes place. Ladies and gentlemen, welcome again to the 2018 David Finch Lecture at the University of Melbourne's Faculty of Business and Economics. I would like to welcome members of our advisory board, our alumni council, and the Young Alumni Committee, senior members of the faculty and university, alumni and friends. I would like to especially welcome members of David's family who were able to join us here this evening. It is fantastic to see so many of you here tonight. It's almost a full house for what will be truly a fascinating lecture. In 1997, the faculty received a generous donation to endow a fund to honor Mr. David Finch by hosting a significant public lecture in his name. David Finch was an alumnus of this university. He graduated with joint honors degrees in commerce and arts in 1944. In 1948, he completed a PhD at the London School of Economics. After a short time at the University of Tasmania, David was appointed to the newly established International Monetary Fund, where he spent the rest of his working life. By the time David resigned in 1987, he was counselor and also director of the Exchange and Trade section of the IMF. His achievements were duly recognized by the University of Melbourne in 2000, 2 years before his death, with the award of an honorary Doctor of Commerce. The faculty is delighted to continue honoring David's achievements through this lecture series, and tonight marks the 22nd David Finch Lecture. I'm proud that over the years, the lecture has attracted world-leading economics and finance experts from academia, government, and international agencies. The lecture has been delivered by a variety of renowned international speakers, including economist Jeffrey Sachs, Dr. Supakai Panitpakdi, Deputy Prime Minister of Thailand, and Stanley Fischer, then Deputy Director of the IMF. Last year, Professor Oliver Gourinchas from the University of California, Berkeley, presented the Finch Lecture on the safe asset scarcity conundrum. Tonight, this tradition of excellence continues. I would now like to invite my colleague, Professor Jeff Borland, to introduce our speaker for the 2018 David Finch Lecture.
Thanks, Paul. Before I introduce the speaker, let me just say thank you very much to Jenny Williams and all of the advancement team for the fantastic work they've done again this year on organising the lecture. The 2018 Finch lecturer is Andrew Haldane, who it's my great pleasure to introduce. Andrew is Chief Economist and a member of the Monetary Policy Committee of the Bank of England. He's also Executive Director of the Monetary Analysis, Research and Statistics. He's founder and trustee of Pro Bono Economics, a charity which brokers economists into charitable projects. In 2014, he was named in one of Time magazine's 100 most influential people in the world. Andrew has lots of, a long list of awards and achievements. I thought instead of reading those out, I'd try and whet your appetite for the lecture by telling you something about his writings and speeches, for which he's acquired a huge international following and reputation. As an official at the Bank of England, of course, Andrew has many speeches and papers and writings on the state of the UK economy, the state of the international economy, financial stability and regulation. And when you read just a few of those, you quickly realise that they're a must-read or essential reading if you want to really stay abreast of international economic developments. They're insightful, lucid, and always involving very careful marshalling and presentation of data. You might think that, well, okay, that's kind of what we'd expect a central banker to be writing on. It turns out that's only part of the portfolio of writing and speeches and thinking that Andrew has. And so I thought I'd mention a couple of other sort of recent speeches that if you haven't looked at them after tonight's lecture, I'm sure you'll be running to the Bank of England website to look at. So in the 2016 talk, The Sneetches, Andrew uses the Dr. Seuss book as a beginning to a brilliant survey of the benefits of diversity in organisations and society. In a 2012 paper, The Dog and the Frisbee, which begins with the sentence, "Catching a frisbee is difficult," and which does in fact include some advice on how to go about catching a frisbee, Andrew spends most of his time providing a detailed and thought-provoking analysis of whether a complex regulatory environment is the best way to control and deal with a complex economic environment. In a speech from earlier this year, which addresses the topic of how to improve public understanding of economics and improve public trust of economists, a topic that Andrew spent a lot of time thinking about and working on recently, he describes how he finds cartoons as an exceptionally useful way to summarise the sentiment and ideas that he gets from the town hall meetings that he attends around the UK. When you look at some of these and other writings, the things that strike you about Andrew's work are his originality, the breadth of coverage of topics, and the incredible breadth of knowledge that he brings to bear on those topics, his concern for the social consequences of economic policy, and the clarity of his writing and expression. I think Andrew is really the master of finding the perfect analogy or metaphor to illustrate the point he wants to make. And to give you an example, and I know cricket's a bit of a taboo topic in Australia, but I have noticed that the English newspapers seem to be taking a lot of pleasure in Australian cricket. So I thought I'd choose this example to tell you about from Andrew's talk, Twin Peaks. In that talk, he uses the example of Joe Root and Ian Bell's their relative batting averages and how those batting averages had evolved as really sort of a perfect way to express his changing thinking on the appropriate monetary policy stance in the UK. So it's a great privilege for us to have one of the world's most imaginative, most influential thinkers on economics, finance and public policy to present the 2018 David Finch Lecture. Please join with me in welcoming Andrew to present the lecture.
Thanks, Jeff. Evening, everyone. Can you hear me? First, you can't hear me. You can hear me. Nod to the back. Good start. Thank you, Paul, and thank you, Jeff, for those over-generous comments, actually. It's all downhill from there, actually. It's my first time in Melbourne. Fantastic to be here. First time at the university. Fantastic to be here, too. I've seen the MCG, so I can now die happy. That's the only time I mentioned cricket all evening. I promised Guy that earlier. It's a particular privilege to be giving this Finch lecture. As Jeff mentioned, a long and a very illustrious line of previous speakers. One of the great benefits of doing it was I could go away and research a bit about Finch myself. And it's very clear that his career was itself incredibly illustrious. Not an exaggeration to say he was one of the architects of the post-Bretton Woods monetary order. And for a citizen of the UK like myself, we have a lot to be grateful to David Finch for, because it was he that led the IMF support mission to the UK in 1976, which in many respects marked the turning point in the fortunes of the UK economy. It was after that that the UK committed to a path of liberalisation and integration of goods and services, of people and monies, a pattern then broadly mirrored right across the globe, and which has, in the fullness of time, delivered higher living standards and lower levels of poverty pretty much in every country on the planet. And that I mention because today we may well stand at an inflection point. There's at least the chance, the risk of the progress made in the freedom and integration of flows of goods and money, people and services being reversed. And that is a risk we should all take very seriously. The stakes could not be higher. However, my topic for the talk tonight is a somewhat different issue, a somewhat different challenge to the international monetary order, and specifically one which is facing central banks such as the Bank of England. It concerns the distributional consequences of the monetary policy actions that have been taken, in particular, over the last 10 years by a whole set of global central banks. The title here, which is far less interesting than the ones that Jeff mentioned, actually, nonetheless, the bit that may not quite fit is the your GDP thing. We tend not to think of GDP as being a personal thing, right? It's an aggregate thing, it's a national thing. But my key message tonight is going to be that we may need, as policymakers, as monetary policymakers, to personalize monetary policy a little bit more, to enhance understanding and its impact, and to enhance trust in central banks. Can we, should we personalize monetary policy, and if so, how? 18 months ago, at the time of the referendum on EU membership in the UK, lots of words were said, lots of ink was spilt, but the best single one-liner was delivered not by a politician, certainly not by an economist, but by a member of the public. It was at a televised debate on Brexit. Professor Anand Menon, who's a professor at King's College in London, was explaining to the audience that in the view of most economists, Brexit would be bad for their economic health. It would damage GDP. In response to which, someone around there in the audience, a woman stood up, pointed a finger, and delivered this memorable line: "That's your bloody GDP, not ours." And in some ways that laid bare a big issue. Issues of the distribution of gains, of inequality, have loomed large in very many public policy debates over the last 10 years or so, and continue so to do. Indeed, we've seen two key issues loom large in public debate. One is that inequality question. We've seen popular bestseller books on inequality, amazingly, by the likes of Thomas Piketty and Joe Stiglitz. We've seen forecasts of that situation getting worse, the rise of the robots making even worse those inequality problems. And alongside that, around the same time, we have seen many central banks around the planet engage in what are pretty extraordinary monetary actions of various types. Interest rates going to their lowest levels, in some cases ever, are augmented sometimes with asset purchases, so-called quantitative easing or QE. It's perhaps therefore not surprising that some have started to beg questions about the fusion of those two issues. That is to say, the distributional impact of those highly accommodative monetary policies. Now, just as a diagnostic on that rising tide of public debate, here's the most scientific of metrics, that the Google search for QE and inequality, both on a rising trend over the last 10 years or so. And the truth be told, despite that accommodative monetary policy intended to support the economy, many in the general public have high levels of mistrust about the impact those measures have had. Here's a survey of the general public in the UK, asked a question about whether they think, in this case, lower interest rates have made them better or worse off. Overall, around a third think that lower rates have made them worse off. And within that, more than half of those towards the older end of the age range think that lower rates have in general been bad for their GDP. And that, among other things, poses a big challenge to people like me. Policies intended to support the economy, to support people, are not showing up in public perceptions of those policies. What's true of interest rates is equally true of QE. That, for many, has done great harm to inequality by raising asset prices and benefiting those most who were already rich. So against that backdrop, I wanted tonight to explore quantitatively the impact of looser monetary policy, not just on the economy at large, but on the distribution of winners and losers across society. Because this, for me, poses pretty existential questions for central banks. Questions have been raised about whether we have stretched ourselves too far, whether we have encroached on issues of political economy. Indeed, whether the days of central bank independence in the study of monetary policy might be numbered. About 6 months ago, the bank held a conference to mark its 20th anniversary of being granted central bank independence. Guy came along and gave a great paper. One of the themes of that conference was that, could it be that the high watermark of central bank independence had already been reached and the only way was down? Well, I won't answer that question tonight. What I will try and do is to shed some quantitative light on this issue of whether central bank policies, their monetary policies, have indeed been bad news for some cohorts of society. So here, roughly, is the plan. I want to start with why is it distributional issues might matter for policymakers at all. Then I want to set out a framework for thinking about that, a quantitative framework for thinking about that, using the UK as a case study, in particular, the loosening of UK monetary policy after the global financial crisis as a case study. I want to end, then, by pulling out a few implications for policymakers, of which the key one will be that this sort of distributional analysis will, I think, be very important for central bankers in future. in boosting understanding of their policies, in boosting trust in their policies. In fact, I'll draw up for you a personalised monetary policy scorecard, which will be looking at how, in this case, UK monetary policy affected particular households in society as a way of personalising monetary policy and as a bridge to improving understanding and trust in that monetary policy. That's the plan. Let's jump in. Why distributions matter? Here's a bold statement. All public policy is distributional. Either it distributes resources between agents at a point in time, or it redistributes resources between agents across time. If public policy is not working one or other of those channels, it is not working. So we cannot avoid issues of distribution and redistribution. That is what public policy, monetary, fiscal, structural, social, does for a living. Indeed, many arms of public policy, therefore, say quite a lot about their distributional impact. Some fiscal policies, some social policies, major on not just their aggregate impact, but their distributional impact. Now, until recently, that was not true to anything like the same extent of monetary policy. It had, if you like, not one, but in fact two get out of jail cards when it came to doing disaggregate analysis. And both could be seen as having their roots in Milton Friedman's presidential address to the American Economic Association 50 years ago, back in 1968. In particular, in that presidential address, Friedman made at least two profound points to this debate. The first of which was that monetary policy, at least over the longer term, was neutral in its impact on real variables. Now, typically, we think of that in terms of total resources in the economy, output or employment, a vertical long-run Phillips curve. But of course, that neutrality result applies with equal force to the distribution of resources in the economy. That is to say, over the longer term, monetary policy ought to be neutral in its impact on inequality. The second point, which is less about objectives and more about instruments, is that typically the instruments of monetary policy operate on an economy-wide or aggregate basis. We can't set a different interest rate for Victoria or Queensland, or for England or for Scotland. So whether viewed from the objectives perspective or from the instruments perspective, it's not clear that distributional issues should be front and center, first order, when it comes to monetary policy. And this perhaps helps explain why there hasn't been relatively little disaggregated analysis of the impact of monetary policy. However, I would argue that that is not to argue remotely the distributions are irrelevant when it comes to monetary policy for three quite different reasons. The first of which is, although neutral in the long run, it's very clear that monetary policy is non-neutral over the shorter run. Indeed, monetary policy is non-neutral over the shorter run precisely because of its distributional impact. So if we are to understand the monetary policy engine at work, the monetary transmission mechanisms, that means monitoring, tracking, calibrating, quantifying these redistributional shifts I mentioned early on. Point one. Point two, central banks are part of a social contract with society. And if that contract is to be upheld, that requires that monetary policymakers explain the impact of their policies to citizens, sometimes in a very disaggregated basis. That is a means of enhancing understanding and a means of enhancing trust, both of which have been casualties of the global financial crisis. And the third reason why this matters, why distributions matter, is that sitting beneath the typical objectives of monetary policy, like GDP, like inflation, is of course some sense of welfare. And welfare and GDP are not always and everywhere the same thing. Whether a rise in GDP translates into a rise in welfare depends upon how large are the gainers relative to the losers, how skewed those gains are towards the already rich. So if we are to conduct a proper welfare analysis of the impact of monetary policy, we cannot avoid taking distributions seriously, as we'll demonstrate in a bit when I do some fully fledged welfare analysis. So distributions matter, including for monetary policy. There is no get-out-of-jail-free card for monetary policy when it comes to issues of inequality, in my view. If you turn to the literature and ask, what does that tell us about the distributional impact of monetary policy, several points stand out. I'll summarize it very quickly. One, there isn't very much of it. That which there is tends to find that while monetary policy does have some impact on inequality, it's in general pretty small. Nonetheless, overall, my reading would be that much of this literature is actually quite ambiguous, quite inconclusive on just how large or significant the impact of monetary policy on distributions might be. Why is that? Well, the main reason is because different of the research papers in the literature focus on different of the channels through which monetary policy operates. It's tended to be partial equilibrium rather than general equilibrium. And as I'll show, that is crucial when it comes to getting an accurate read on what impact monetary policy might have on inequality issues. Indeed, it helps explain this large perception gap on the part of the public. So the largest reason for that perception gap between the public and policymakers is because the public focus only on those channels of monetary policy that are most direct and immediate. They too are doing partial equilibrium rather than general equilibrium. So let me get on then to the numbers. What I'm going to do? I'm going to do a so-called micro to macro or the macro to micro simulation approach. There's a working paper here, a recent one from the bank, that sets it out in more detail. But roughly it comes in 3 stages, and I'll start with some distributions of income and wealth in the economy. Remember, the UK is my case study. And I'm going to assess the impact of monetary policy on those distributions, working through a variety of channels, and then look at how the final distributions look. How has monetary policy affected the shape of income and wealth and other things across the economy? I can cut this cake any which way. I'll show you some of the dimensions. There's others in the background speech which came online at the moment I started speaking. So here's the initial distributions. This is for income and wealth before the global financial crisis. I've taken the UK, although you find similar pictures in most other countries. It's ranked by income decile left, wealth decile are on the right. And the key takeaway here is just how uneven this initial distribution was. To the top 10% by income, that accounts for around 25% of total income, that top decile, and about 60% of total wealth, whereas the whole bottom half accounts for around a quarter of income and around 10% of wealth. So a pretty uneven distribution, even before monetary policy started becoming much more accommodative after the global financial crisis. In fact, if we now compare those distributions before the global financial crisis, 2007, blue line, with how those distributions look in 2012, 2013, that's the red line, there is little to choose between them, certainly in income terms and to some extent in wealth terms as well. So prima facie, there has not been much, if any, of an increase in inequality over the period where monetary policy in the UK has become materially more accommodative. So on the face of it, this is suggesting that monetary policy hasn't done that much to worsen inequality problems. But of course, this is just a simple comparison. This doesn't partial out the impact of other factors other than monetary policy in affecting inequality. So what I want to do is look at the distinctive impact of monetary policy on those distributions. Using this approach, I'm going to focus on a particular episode, which is the very material loosening of UK monetary policy after the global financial crisis. That's a cut in interest rates of 5 percentage points, plus, on top of that, almost £400 billion worth of so-called quantitative easing. So very material loosening of monetary policy, almost certainly the most material loosening of monetary policy in the Bank of England's 325-year history. And then as a first stage, you're going to ask, what impact would we expect that loosening of policy to have on a set of aggregate macro variables, the ones listed here: interest rates, employment, wages, asset prices, consumer prices, using a pretty bog standard macro model, asking, if you like, the counterfactual question: how might these macro variables have evolved had UK monetary policy not been loosened? That's a thought experiment. How would things have looked counterfactually without this loosening of monetary policy? And here's the answer, I hope. There's the answer, look. For GDP and for unemployment, so roughly speaking, what we find is that without that loosening, GDP would have been around 8 percentage points lower, unemployment would have been around 4 percentage points higher, and not shown here, consumer prices would have been around 20% lower, in the absence of the monetary loosening that accompanied the global financial crisis. Pretty chunky macro impacts, beneficial impacts. But of course, the interesting question is not just was the aggregate impact big, but how were those gains distributed across households? And that I'll now turn to assess using very detailed, granular household balance sheet data, a representative sample of around 10,000 UK households, all their characteristics: their income, their wealth, their education, their age, their assets, and their decomposition. Using that to map from those macro aggregates to their income and wealth and other things operating through these 4 channels. The key point here is multiple channels for monetary transmission. There's the one that people observe most directly, which is to say, the cash flow channel. When interest rates change, the amount of income people receive on their savings changes, as do the interest payments on their debt. This we can calibrate household by household for each of those 10,000 households. A second channel, less readily observable, less direct, is the impact monetary policy has on the labour income of those households by boosting both employment, jobs, and wages. This, too, we can calibrate based upon the age and the education and the skills of each and every one of those 10,000 households. A third channel through which monetary policy operates is the wealth channel. Looser monetary policy boosts asset prices and therefore boosts the wealth of those households, all 10,000 of them, whether in the form of financial wealth or housing wealth or pension wealth. We decompose that. And the final channel is, if you like, the inflation channel. That is the impact that prices have on the real value of nominal contracts, such as deposits or debts. So what I'm going to do is take the macro impact and then map it through each of these channels to the balance sheets of all of those 10,000 households and ask what impact it has had on their income and their wealth and how that's distributed across society. It's like the general equilibrium impact of the monetary loosening on each and every one of those households. How does the picture look? Here's how it looks. This looks at the distribution of income broken down by decile. Here on two bases. On the left-hand side is the gains or losses defined in terms of pounds, in money amounts. Right-hand side defined in terms of percentages of income across the various income deciles. The average is here at the end. And in income terms, what this tells us is that the average household in the UK benefited per year, or across the period of the loosening, 6 or 7 years, by around £9,000. Or added to their income by around £1,500 per year, or 5% of disposable income. Worth having. How are those gains distributed? If we look at this in percentage terms, relative to people's initial incomes, almost everyone's income rose, with the exception of the lowest income in distribution. If you did the Gini coefficient based on this, you would see that the Gini coefficient is almost unchanged. Inequality is pretty much unchanged in income terms as a result of the loosening of monetary policy. Of course, while that's true as a fraction of income, if you look at the money amounts by which people gained, those differ very materially. They differ very materially, of course, because the pre-existing distribution of income was so uneven. It is not that monetary policies are making that any worse, but in money amounts, the gains look to have accreted most significantly to those who were already wealthy. And that might matter. It might matter to people's perceptions that the rich are gaining more in money terms, even if in percentage terms they are not. That's the income distribution. This is it for wealth. This is the impact across the wealth distribution of that material loosening of UK monetary policy, on average, the average household has gained across those 6 or 7 years in wealth terms by around £90,000, about 20% addition to wealth for the average household. Pretty chunky. What's more, those gains are pretty evenly distributed, at least as a fraction of initial wealth. The wealth genie, the genie for wealth is pretty much unchanged as a result of the monetary loosening. What was true for income is also true for wealth, though, which is, if you look in money terms, of course, these gains are quite unequal. The already rich have gained very much more in monetary terms than have the already poor. That's not about monetary policy. That's simply a reflection of the uneven pre-existing distribution of wealth across society. Different cut, this is by income and wealth. Here's it by age. This looks at the distribution of income and wealth, again looking across the age cohort now. And here the patterns are more interesting. So here's income, and the dark red here is labour income. You see that the biggest beneficiaries here have been the young, and that's because they've benefited most in employment terms from the loosening of policy, and also because they tend to be debtors, and therefore the biggest beneficiaries of lower interest rates on those debts. Whereas older cohorts, not in the world of work, don't benefit from enhanced jobs or wages, but do suffer the consequences of low interest rates on some of their savings. That's true of income. Of course, the flip side of that is what's happened to wealth across the age distribution, where the pattern of gains has been pretty much across the board. At least in money terms, the biggest wealth gains have come to the oldest, for the simple reason that they had the most wealth to begin with. Indeed, the wealth gains here, in money terms, outweigh the income losses here by a factor of around 10 to 1. So it's very unclear from that overall that anyone has been made worse off as a result of the monetary loosening. But let me try and formalize that intuition now by moving from income and wealth space into welfare space. We have a fully fledged welfare analysis of the impact of that monetary loosening on the well-being and welfare of those 10,000 households. For example, this will help us address the question, how do we relatively weight gains to income and gains to wealth, gains to present income versus gains to permanent income, if you like. It'll allow us to address, should we care about percentage gains relative to income, or money amounts? It'll also help us take account of factors other than money that may have a bearing on people's well-being. For example, it's well known that the benefits to happiness, to well-being from getting a job is some multiple of the income you get from that job. It adds to your sense of self-esteem, of well-being, of welfare, over and above any pecuniary benefit in higher salary. So I now want to use some welfare analysis to try and engage with each of these questions. Here's a welfare function. I'm going to estimate this welfare function based upon some empirical measures of the satisfaction and happiness of each of those 10,000 households, which conveniently our survey asks them about. So we estimate individual utility functions based upon all their characteristics, including their income, Y, their wealth, B, and other factors, X, which includes the effects of improved employment prospects, reduced job insecurity, and reduced financial insecurity. And that's what I do here. I'll not give you the details, but we basically estimate welfare functions for each of those 10,000 households. And the result of that is shown in the bottom of the picture. What does that tell us? It tells us unsurprisingly that both income and wealth matter for welfare. Indeed, it gives us the relative weights that attach to those two things. It tells us that a log specification of this welfare function fits best, which is to say percentage increases matter more to satisfaction than do money amounts. And it also tells us that job security, higher employment prospects, have an effect over and above the impact of income, indeed a very powerful effect. The effect of having a job has an income equivalent impact on welfare of around 3 months' salary. So taking this specification of welfare, I can now turn to a measure of the distributional impact of policy measured not in income or wealth terms, but in welfare terms. And this is what it tells us. This is the welfare impact of monetary policy, looking across, on the left-hand side, the income deciles, on the right-hand side, the age deciles. And the key point, one of the key points is that now everyone is a winner in income terms. Everyone's a winner even looking across the age distribution. And one reason for that is because the effects of lower unemployment, of higher jobs, has a very significant impact on welfare. That's the green bars in these diagrams. If we only looked at the financials, this would very significantly underestimate the positive impact monetary policy has had on the well-being of those 10,000 households. Its impact in lowering job insecurity and in lowering financial insecurity has been every bit as important to happiness, to well-being, as the pecuniary impact on their salary or on their wealth. So the picture from here, from this full welfare analysis, is that the distributional impact of monetary policy is even less of a dilemma than appeared from the income and wealth analysis. So summarizing this then, what do we find? Monetary loosening, significant aggregate benefits, pretty well distributed across most cohorts, whether age or income or wealth or indeed region. That's reinforced if we look at this in welfare terms rather than financial terms. If we look at the fraction of households that have been losers, that tends to be pretty small. So why then, if you bought this, do the public not believe it? Why then is there this big perception gap between the public's sense of what monetary policy has done for them and my welfare analysis of the impact of policy on them? Here's that gap. Left-hand side, that's the picture you saw about half an hour ago. Surveys of the impact of lower rates across age cohorts. That's the same distribution in my welfare terms across the age distribution. The key point is these are all negative, these are all positive. There's a sign difference. What is going on? Well, the difference, very simply, is that this is partial equilibrium. This looks at the impact working principally through cash flow effects, the ones the public can observe immediately. And this is the general equilibrium impact of those same policies operating through channels that are often not observable and direct to the general public. This is not that the public are wrong, and it's not that policy isn't working. There is simply a perception gap between policymakers and the public, which takes me to my punchline, which is that we should and indeed could do more to close that perception gap between the public and policymakers, to provide the information to the public to enable them to understand the full impact of monetary policy, not just on the economy, but on them as individuals. So in other spheres of public policy, this is well-trodden ground. When there exists a dislocation in perceptions with the general public, things can be done to frame policy in ways that increase understanding and trust in those policies. In the sphere of tax policy, a few years ago, the UK government started issuing tax statements which told people not just how much they were paying, but on what those tax receipts would be spent. Schools, hospitals, roads. And that personalisation of their tax return has been shown to increase understanding of, in this case, fiscal policy, tax policy, and indeed compliance with tax policies. The localisation or personalisation of policies can boost understanding, trust, and compliance with public policy. And what's true of tax policy could be true, to no lesser extent, of monetary policies. We, as central banks, could choose to make available information to people on a very disaggregated basis, telling them the way in which monetary policy has affected their balance sheet through the various channels that I have described. In fact, that's not a hypothetical thing. I've done it. Here it is. Here's a monetary policy scorecard for two. I've chosen two random household types. Left-hand side, this is a household aged under 30, so young, debtors, not owning a house, they're renting, they're on a low income. I could choose anything, right? I could choose any characteristic of a household in the UK. On the right-hand side, I've taken someone older age end of the spectrum. They own their house outright. They've paid off the mortgage. They are surviving on their wealth. This runs through line by line. This is how monetary policy has affected your net interest income in pounds of this period. That's for your labour income. So it's been positive for the young. It's largely left the over 50s unaffected. Wealth, all the gains accrete to the older. They own all the wealth. There's a reduced probability of unemployment. That's the welfare effect, a big effect on people's income equivalent well-being. We can line by line tell people the way in which monetary policy is affecting them as people, as a way of localizing, personalizing the impact of policy, as a bridge to making that policy more understandable, more trustworthy. In principle, I could draw this up for each and every one of those 10,000 households, laying bare how monetary policy has affected them. Sometimes it has hindered. So in net interest income terms, the old have lost out. But hang on. Look along the full balance sheet. Look at the gains you've reaped in wealth terms from those same policies. Right now, the public focus on this line and this line alone. This would lay bare the fullness of the channels through which monetary policy takes effect. Jeff, I'm pretty over time, aren't I? I should shut up soon, shouldn't I? David? 2 minutes. 2 minutes, excellent. Conclusion, thank God for that. What have I done? I've set out a framework for thinking about the distributional impact of monetary policy in quantitative terms. It reaches a broadly optimistic conclusion. Monetary policy has not been first order in worsening issues of inequality, whether of income or wealth, or indeed welfare. Most have been gainers. But that's not the end of the story, because the point is that this should perhaps not be seen as a one-off exercise, as a defensive measure. We as monetary policy makers perhaps should have more of this on an ongoing basis, as a way of explaining to people, ordinary people, the impact that our policies are having on their wealth and welfare, as a means of boosting understanding of those policies and as a means of boosting trust in the policymakers executing those policies. 18 months ago, when that lady stood up in the audience and delivered that line, "That's your bloody GDP, not ours," there was no right of reply. But armed with this analysis, you would have right of reply. What this analysis shows you is that our reply could have been, perhaps should have been, no, it's not. It's yours too. And who knows, had that line been delivered, who knows how that referendum may have turned out. I will stop there, David. Thank you very much for listening.
Well, thank you very much, Andrew, for a fascinating lecture. My name's David Dixon. I'm head of the Department of Economics. I would now like to invite the audience to ask questions. I should say that we're running just a few minutes behind schedule, so I'm going to keep this fairly brief. If you've been invited to the dinner afterwards, please don't put your hand up. We've got 2 roving microphones, so please wait for a microphone to come. So maybe start with the gentleman in the white up here.
Thank you very much for your presentation. It seems to be a very logical and rational process, but I question 12% of net losers as being a small number.
Okay. Yeah.
I mean, a politician would be shot for saying that, oh, by the way, a monetary policy has only got 12% net losers.
Yeah, yeah. Should we collect some? Let's collect some, David. It might make it. Let's collect 3 questions and I'll come back.
All right.
Try to remember them.
Mic is working.
Yeah,
okay. How would your analysis vary if you included the other main limb of most central banks' function, split in this country between APRA and the bank, which is prudential policy? And how would it vary if you looked over that whole 20 or 25-year period in which independent central banks presided over that very large increase in the size of bank balance sheets and a big change in asset prices over that time?
Yeah. Take one more, then attempt to answer one.
I'm just interested in why it seems to have been so hard to convince the public that this has been a positive overall impact. If it has been, I guess I work in public relations and I think you need a good PR manager.
How much she cost? Okay, let me take this in reverse order. So on this, I mean, it's complicated. It is complicated, right? I mean, it's devilishly complicated. And truth be told, sometimes in the monetary policy sphere, there's a degree of trust us. Trust us for a central banker. And that worked pretty well for quite a long time. But in some ways, that the crisis has done quite some damage to that social contract I mentioned earlier on. And therefore, people want more than a trust us statement. They want to be walked and talked through the impacts. I think that's why we need to go that extra leg and explain to the public directly what we are doing, why, and how it's affecting them. Not the view from 30,000 feet. The view at ground level. That's affecting them. Some with their characteristics, their debts, their assets, their income, their age, their education. Make it personal. Make it personal. So I think that is the step. It's a big step for central banks. It's not without risk. It is not without risk. But I think in terms of recapturing that trust, this would be one way to go. Regulatory policy. So I haven't covered that. So the honest answer is I don't know. I could guess at the answer, which is I think it's widely accepted now that pre-crisis regulation was not up to snuff, was not doing its job, and that, combined with other things, sowed the seeds of the crisis, the consequences of which I've been discussing this evening. That's a welfare analysis for another day. I suspect it would not reflect kindly on the pre-crisis evolution of regulatory policy, to say the least. There's, of course, then the post-crisis impact of regulation. Some work has been done on that. And is it the case that that tightening of regulation has had an adverse impact on the economy? My reading of that literature is that that impact has not been particularly adverse, if indeed it's been adverse at all for credit conditions. Which is another way of putting the point that banks with lots of capital tend to lend. Banks without capital don't. So if you want banks to lend, you best get them some more capital pretty quick. And that has been the course of regulatory policy since the crisis. And net, I think overall that's been positive for the economy and therefore for the households within it, but I haven't done the full welfare analysis myself. Pre-crisis, different story. And then, is 12% a large number? Well, I don't know the answer to that question. We should not pretend, we ought not to pretend that everyone's a winner when some people aren't. I think the best you can do in that situation is set things out as clearly and coherently as possible. You can still make the point, we ought still make the point, that even though there are some losers, the economy overall has been materially better off for having pursued this course. And in my experience, when I speak to people around the UK, they get that actually. And they are understanding, provided you don't pretend that they are winners too, when they know themselves they're not. And that's a great point too. Yeah, that's a great point too. That another way of thinking about this is that maybe next time around, the fraction of losers will be larger. Now, monetary policy is the wrong tool for dealing with that, for all the reasons I said at the beginning. But that could then be a call to arms for the other arms of policy to help compensate for some of the distributional consequences of an action that still delivers aggregate benefits. I think that's where you were going with which I agree with your point.
Okay, well, I appreciate that there are other questions, but I'm afraid that I have to wind things up here. So, Andrew, I'm just going to give you a small gift. Thank you very much. As a token of appreciation from the faculty.
Thank you, David.